Welcome to the SNN Network Canada virtual event. I'd like to introduce our next presenter, Mark Waldron, CEO of VIBE Growth. Mark, the floor is yours.
Thank you so much. I just want to thank SNN for having us this week. It's been a great conference so far. It's just a real pleasure to present. I'll just jump right in. As said, I'm CEO of VIBE Growth Corporation, Mark Waldron. VIBE is an operator of cultivation and retail assets in California, almost exclusively. We have one store in Oregon, but the rest of our 6 retail stores, as well as our cultivation assets, are in California. And that's really entirely our focus, is to expand our footprint throughout the state of California. VIBE is listed on the CSE. We went public back in April 2019. Our ticker is VIBE. And I'll say that as a little bit of background, we've done 2, fundamental raises for the company. One in the spring of 2019, a little under $15 million Canadian, and we did a bought deal through Beacon Securities earlier this year in the amount of about 16 million Canadian. So we haven't raised a lot of money, and so that's why we're quite proud of our footprint in California. We've really been bootstrapping this operation for the last couple of years. So we operate very fiscally conservatively and prudently, and I think we've done some excellent growth and have excellent growth prospects with a rather solid but small balance sheet. So I'll just jump right in. Our focus is expanding our retail store footprint under the VIBE by California brand name in California. I would say that as a company, we're about 30% strategy focused and 70% execution focused. That is to say that the strategy is pretty straightforward. We're vertically integrated. We're looking to feed our stores with a lot of our own cultivation product, flower and processed product. That means that we think that vertical integration is the key to healthy margins in California, and it's really a key competitive weapon for us. We've got 3 cultivation operations in California, one in Crescent City, one in Sacramento, and a nascent one in Monterey County. And we have 6 stores in California, one in Portland, Oregon. Our store locations are Ukiah and Redding, Salinas, Sacramento, Stockton, and Palm Springs. I'll skip forward a little bit here in the presentation. Our new slogan is "It's always 420" at VIBE, and that's really truly the case. Whether you're in our stores or you're consuming our products and that are cultivated from our own operations, we love the slogan "It's always 420" at VIBE. It's actually a new one that we're introducing. It's part of a little bit of a refresh brand of that we're doing for VIBE by California. Skipping forward a little bit. Why we love California, we know the marketplace. Our management team is concentrated there. We're focusing more on Northern California than other geographic areas, just because it's a way for us to have a concentric management team. But we love the size and scope and scale of it. We kind of know where the bodies are buried, so to speak. There's been some consternation about the competitive aspects of California. We actually think it's a great place to operate. Ultimately, like any other, branded product, you have to be a low-cost provider, and I think that's really what VIBE is focused on, is low-cost provision. So we think that what we've seen in terms of compression of commodity prices in California and the flower and cannabis space, it's not something that concerns us at all. We're really a low-cost provider, and it's something that we're quite proud of. Skipping forward to the next slide here. So we've been profitable for the last few quarters, and it's something that we're entirely focused on as a company. We're focused more on EBITDA expansion and margin expansion as a company more than even revenue growth. That having been said, we think next year is going to be a very substantial year for revenue growth for us, but we don't chase revenues. Basically, we're looking for profitable returns on capital. So we've been profitable. I think we've got great growth potential. As I said, we have 7 stores, 2 of which are opening in the next couple of months. We've got 3 cultivation operations. And what I like about our forecast for next year is that they're predicated not on further M&A, but basically just developing the assets that we have currently under our belt. So when we talk about our projections on EBITDA and revenues later here in the presentation, it's based on the assets that we actually already own. And I think that's something that's really important to point out, because we do see a lot of hockey stick projections in the cannabis space, but sometimes that's based on further M&A, and that's actually not even what we know. We're looking for further M&A opportunities, but basically we're also really happy with the current portfolio that we have. In terms of the management team, my background is investment banker with JP Morgan, and I did quite a bit of private equity over the last 20 years. At one point, I was the CEO of a turnaround situation for Domino's Pizza of Canada, so oversaw their 250 store corporate and franchise network in Canada. The rest of the leadership team, Joe Starr, our COO, he and I have been in business together for over 15 years now. Mike Hollov, our CFO up in Calgary, we've been in business together for over 10 years, and Calvin Yee, our head of business development, someone who's worked for me for the last 20 years in various business development capacities and other public companies as well. So very strong management team, and we really know each other quite well. So we're quite happy about where we are. What we're focused on in terms of leadership in California is expanding our middle management team, and that's something that we've actually made some nice gains in over the last few months. So talk a little bit about our strategy in California, though I'll reiterate, it's not really rocket science. We're 30% strategy focused and 70% execution focused, but it's all about vertical integration for us. We're looking to develop further cultivation assets, flow as much of that product through our stores. I think it's important for branding, for quality control, for the customer experience, but also for margin expansion. I think without that, it's pretty hard to compete as a pure retailer in California or as a pure cultivator, and that's why we've seen cultivators looking for more retail stores, retailers looking to hook up with cultivators. I think that's actually what we've already been doing over the last couple of years. Looking for accretive growth opportunities, looking to expand our retail store footprint from the current 7 to 12 stores. How do we get there? Basically de novo developments, taking licensed locations and opening those stores. So we're looking to acquire licenses in key areas, but we're not looking to acquire mature stores. We're looking to acquire new locations and expand those footprints. Just in terms of where we're coming from and where we think we're going, our forecast for this year is a little over $30 million US in revenues, with EBITDA of about $3 million US. Even with those fairly, I guess I would say, standard numbers, I think our EV multiple is pretty attractive as a value play. But when we look at our forecast for next year, we're looking to double our revenues in US dollars, and we see substantial EBITDA expansion, mostly because some of our larger cultivation assets will be coming on stream. So on a forward-looking basis, I think our EV multiple looks extremely attractive, and we're hoping to get up to 12 stores next year, so add another 5 to our current footprint. So just to re-summarize, these are our retail locations. We're really excited about 2 new offerings that are coming on. One in Salinas, a location right on the just 20 feet from the 101, northbound traffic. That store should be open in the next couple of months. I think it's going to be a bit of a home run for us, so we're excited about that. And then another store that's at the last sort of legs of regulatory approval in Ukiah, that should be on board in the next sort of 3 to 4 weeks. So that'll bring us to a store count of 7. In terms of what we're doing in cultivation, we've had Crescent City as a greenhouse grow for the last couple of years. That's just a little under 20,000 square feet. Sacramento, we started with 5,000 square feet of premium indoor grow, and we've been expanding that. That's doubled to 10,000 square feet, and we're just in the process of a phase 2 expansion to 20,000 square feet. And Monterey County, it's a site that we acquired earlier this summer, entitled for 250,000 square feet of greenhouse grow. And what we've announced publicly is that we're doing a phase 1 build out there, 65,000 square feet of premium greenhouse grow with supplemental light and climate controls. And we expect that construction will be done by June of this coming year, and we'll be pulling flower there in August or September of next year. So that's an exciting project for us. If market conditions warrant it and our balance sheet allows it, we'll we'll actually develop that a little bit more quickly. So phase 1 is 65,000 square feet, and we have the power in place for that, but we'd like to develop that a little bit more rapidly. So we'll see how that goes. So just in terms of our cultivation footprint, this is kind of where we are in indoor and greenhouse and where we're going. But we are extremely focused on expanding that cultivation footprint because from a quality control perspective, from a branding in our store perspective, it's really one of the key distinguishing factors, and I think it's what's going to allow us to stand out from other retailers in California. We focused a lot on our online experience, whether it's through our website, through our mobile app, which we recently launched, and we've seen quite a bit of e-commerce activity. I think we're tracking a little over 22% right now of our orders are coming online, and we expect that will continue to creep up, and we're hoping to target about 30% of e-commerce revenues for the VIBE platform. So in terms of branding, we've added some firepower to our marketing and branding team, and we're quite excited about that. And what we've seen is quite a bit of uptick in our social media channels as we relaunch some of our portals. And I think just from just purely an aesthetic perspective, I think we're a little bit more targeted on our key demographic, on our consumer, and I think we're generating a lot more excitement in some of our channels, whether that's on YouTube or Instagram and some of the other platforms. So it's something that's important to us. That having been said, as important as sort of visual branding is, I think the biggest aspect of branding in California for us is through the curation of our own cultivated product. And again, that's something that we're going to keep emphasizing. It's really more about quality than imagery. Imagery is sort of an adjunct to the quality product that we're bringing online as VIBE by California. So just a little blurb on our new brand evangelist. Mary Ellen's been in place for the last 4 months now, and she's really made an impact, and we're getting a lot of good feedback from our customers as just what VIBE is all about and what it appeals to. So I think demographically we're starting to nail things down a little bit more than we did in the past, and we're excited about that. I'm going to skip forward a little bit here, folks. Just bear with me for a second. There's a little lag here in the presentation. So I want to talk a little bit more about Monterey cultivation. It's a significant asset for us. And when we talk about what we mean by greenhouse grow, again, I think the sweet spot in California right now is sort of high-end greenhouse grow assets. That is to say climate control and sort of light supplemented sites with some advanced and control systems in place. Why? Because it emulates indoor grow quality, but with a much lower cost basis. And so that's really the key thing. As we see prices coming down a little bit for flower and other accessory, sort of adjunct products in the space, to the extent that you have control of your costs, whether it's from an energy perspective or a debt service perspective, or what capex you've expended, I think high-end greenhouse grow is really the better medium between outdoor grow and what is relatively high-cost indoor grow. And so that's what we're really focused on, and I think the margins are pretty substantial there. So this coming year, we're bringing on 65,000 square feet of greenhouse grow in Monterey. That having been said, towards the sort of second half of next year, we may well be into a second phase of adding another 90,000 square feet there. So we'll see how the market tracks, but I wouldn't be surprised if we announce phase 2 over the next few months. Just a little summary on the company from just a cap structure perspective. A little over 100 million shares outstanding, a pretty clean cap structure. We don't have a lot of bells and whistles out there. We have some warrants outstanding from a bought deal unit offering that we did earlier this year, but pretty easy to understand. And I think from an enterprise value perspective, compared to projected revenues or projected EBITDA, again, I think we're pretty much a value play. We have very little debt on the balance sheet. We'll be adding probably about $3 million of debt over the coming couple of months to support the greenhouse build out in Monterey. But I think you're really looking at a balance sheet that'll have less than $5 million of debt come sort of mid part of next year. We're not burning cash. We've been FFO and cash flow positive over the last 6 months or so. So I think, you know, we're pretty easy to understand. I think really the proposition for VIBE is, you know, can we double revenues next year and get our EBITDA over $10 million US? I think the answer is yes, based on the assets that we have in place, the management team, and our prospects for execution. So we're pretty excited about the coming 12 months. It's really just about execution, adding to the management team, keeping costs down. And so it's not the sexiest presentation. I'm not going to go into a lot of strategy because it's really just vertical integration and execution. But I think it's going to be a great year for us next year. I'm going to put a cork in it for now and leave a little extra time for questions to the extent that there might be some out there. So thanks very much for your time. That's VIBE in a very quick nutshell, and happy to open it up to Q&A. I'm just looking through some of the questions here, so let me just jump right in here. What is your vision for the company in the next 12 months? Where would you like to be? We'd like to have 12 or more retail stores, and I think what we're seeing is there's some cracks in the dam out in California. There's some undercapitalized groups or groups that have burned through a lot of cash, and they're having trouble combining cultivation with retail. And so we see some retail assets coming onto market at some more reasonable valuations. So I think we're pretty optimistic that we're going to be able to add to our retail footprint in a cost-effective way. And so that's really our vision, is besides bringing on more cultivation assets and capacity and throughput, getting to at least 12 stores. And I think we've got a pretty good chance of doing that. Can you provide, another question, can you provide greater detail on why you are not concerned with the price compression in California? You know, a lot of the price compression is at the lower end of the quality spectrum, whether it's outdoor grow or whether it's a low quality greenhouse grow, or for those that haven't focused enough on either branding or retail distribution. Some people have had to seek, you know, quick methods through the wholesale market, and really that's an area that we'd like to avoid, is just dumping product in the wholesale market. So I think as a low-cost provider and as a branded product with retail distribution, I think that margins should be pretty healthy for the company next year. Another question, are you confident hitting next year's targets on the back of declining cannabis price that we've seen this year? So our forecast is actually based on lower prices for cannabis flower and other cannabis products. So I think our forecast is pretty conservative, and I think while prices might go down a little bit more, I think we've already seen a lot of that compression happen. But as long as we keep costs under control, I think our margins are going to be pretty substantial. What are the competitive advantages that VIBE has that would allow you to succeed in the marketplace where it seems multiple MSOs have not yet been able to do so? I think it's so much about boots on the ground, having a competent management team close at hand that understands the market, that isn't just throwing capital at problems. And we've seen, I think, a little bit too liberal dispensation of capital in California. And really, I think it's really important to have a tight-knit management team and middle management team in place and to keep costs under control. So I think that's really the key to success in California, is just running a very tight ship. And I don't think there have been that many vertically integrated type ships out there. Just looking at the next question, bear with me. Do you have any data that would indicate that you're seeing more return customers and your branding strategy is working? We've launched a lot of sort of in-house SKUs in our stores, and the feedback has been tremendous, whether it's online reviews or just word of mouth or surveys from our consumers. So I think our branding strategy is working. Again, to us, branding is not about imagery. It's less about packaging and sort of some of those aesthetic design components. I think it's mostly about quality, and I do think that our strategy on that front is actually working. I think we've gone through the list there of questions. I'll give it a little time here. What are some of the criteria that you use when looking to buy a retail dispensary? Pretty simple: location, competitive landscape, cost of entry, so working capital and TIs to actually get that store open. If it's a de novo, if it's an existing one, again, it's an area that we're tending to shy away from, because if it's a mature dispensary that has low margins, there's not a lot of sort of gas left in the tank to do much with it. You know, if the cost of entry, if the cost of acquisition is already high, so we're looking to, you know, open up new stores at a relatively low cost, you know, sort of level that is under $3 million per store. And so the criteria is cost of entry, location, you know, nearby highway accessibility, vehicular traffic, ability to market in that area, billboards, pretty standard criteria. So we're at the 25-minute mark. I don't see any other questions, so I think I'd just like to thank the audience and SNN for hosting us this week. It's been great, and I look forward to other one-on-one investor meetings later in the day. And thanks again. Please contact us directly if you have any further questions, and appreciate your time today. Thank you.